The boardroom at Sears Holdings headquarters in Hoffman Estates, Illinois, held the understated confidence of a retail empire that had defined American commerce for over a century. In spring 2005, recently appointed Chairman and CEO Eddie Lampert outlined his vision for the newly merged entity combining Sears and Kmart into a unified retail powerhouse. The presentation emphasized operational synergies, cost reduction opportunities, and strategic repositioning that would restore profitability to both struggling chains. Financial projections showed substantial savings from eliminating redundant operations, consolidating purchasing power, and optimizing real estate portfolios. Board members reviewed integration timelines and performance metrics while discussing the competitive landscape that included Walmart, Target, and emerging online retailers. Lampert's hedge fund, ESL Investments, had orchestrated the $11 billion merger after acquiring both companies through separate bankruptcy proceedings. The executive team expressed measured optimism about transforming two declining retailers into a competitive force capable of challenging industry leaders. The atmosphere reflected institutional determination to execute a complex turnaround strategy supported by substantial financial resources and operational expertise. The foundation of transformation, Sears, Roebuck & Company, represented one of America's most enduring retail success stories. Having evolved from a mail-order catalog operation in 1886 into the nation's largest retailer by the 1960s, the company's catalog business had connected rural America with manufactured goods, while retail stores anchored suburban shopping malls and served as community gathering places for middle-class families. Sears' integrated business model encompassed manufacturing, financial services, real estate development, and retail operations that generated substantial competitive advantages through scale and vertical integration. The company's brand portfolio included Craftsman tools, Kenmore appliances, and Die-Hard batteries that commanded premium pricing and customer loyalty across multiple generations. Sears' private label strategy created differentiated products unavailable elsewhere, while exclusive supplier relationships ensured consistent quality and competitive margins. The company's credit card operations provided additional revenue streams while facilitating customer purchases of higher-priced merchandise. Kmart Corporation had emerged as a discount retailer in 1962, competing directly with Walmart and Target in the growing mass merchandising sector. The company achieved rapid expansion through aggressive pricing strategies and suburban store locations that served price-conscious consumers seeking national brand merchandise at reduced costs. Kmart's blue light special promotions became cultural phenomena that drove traffic and created shopping excitement. However, both retailers experienced significant challenges during the 1990s and early 2000s as competitive pressures intensified and consumer preferences evolved. Walmart's superior supply chain management and cost structure enabled lower prices that eroded Kmart's competitive position, while Target's emphasis on design and quality attracted consumers seeking affordable fashion. Sears struggled with aging store formats, declining mall traffic, and competition from specialty retailers in appliances, tools, and automotive services. Eddie Lampert's investment approach reflected his background as a successful hedge fund manager who specialized in distressed retail acquisitions and turnaround strategies. ESL Investments had generated substantial returns by acquiring undervalued retail properties, extracting real estate value, and implementing operational improvements that restored profitability. Lampert's analytical approach emphasized financial engineering, cost reduction, and asset optimization rather than traditional retail merchandising and marketing strategies. The strategic architecture. The Sears-Kmart merger created the third largest retailer in the United States, with approximately 3,500 stores generating over $55 billion in annual revenue. Lampert's integration strategy focused on leveraging the combined entity's scale advantages while eliminating redundant operations and optimizing underperforming assets. The plan included store format conversions, private label expansion, and cross-merchandising opportunities that would differentiate Sears Holdings from pure discount competitors. The newly formed company inherited substantial real estate assets through prime mall locations, freestanding stores, and distribution facilities that represented significant value independent of retail operations. Many Sears stores occupied large footprints in established shopping centers, providing opportunities for subdivision, subleasing, or outright sale to generate capital for operational improvements. This real estate value offered financial flexibility during the integration process and provided potential exit strategies for underperforming locations. Lampert's management philosophy emphasized decentralized decision-making and internal competition between different business units as mechanisms for improving operational efficiency and innovation. The approach reflected his belief that market-based competition would naturally optimize resource allocation and performance by allowing successful divisions to expand, while unsuccessful operations would be eliminated or restructured. The company's organizational structure divided operations into separate business units responsible for specific product categories, store formats, or functional areas. Each unit operated as an independent profit center with distinct financial targets, compensation structures, and performance metrics. Unit managers possessed authority over pricing, merchandising, staffing, and promotional activities within their areas of responsibility. This internal competition model attempted to replicate market dynamics within the corporate structure by creating incentives for unit managers to maximize their individual performance rather than optimizing overall company results. Successful units received additional resources and expansion opportunities, while underperforming units faced budget reductions and potential elimination. The system aimed to identify and reward high-performing managers while weeding out ineffective operations through competitive pressure. The implementation Sears Holdings implemented the internal competition system across all major operational areas, including merchandising categories, store formats, geographic regions, and support functions. The men's clothing division competed directly with women's apparel for floor space, promotional budgets, and corporate investment. Hardware and automotive departments operated as separate entities with distinct profit and loss statements, even when located within the same stores. Each business unit developed independent relationships with suppliers, negotiated separate contracts, and maintained individual inventory management systems. The fragmented purchasing approach eliminated the company's traditional scale advantages in supplier negotiations while creating administrative complexity and operational inefficiencies. Units often competed for the same suppliers, driving up costs and creating conflicts that damaged long-term vendor relationships. The compensation structure tied executive and management bonuses directly to individual unit performance rather than overall company results. Unit managers received incentives to maximize their own profits even when such actions negatively affected other divisions or overall corporate performance. This created systematic tendencies toward suboptimal decisions that benefited individual units while harming the broader organization. Store-level implementation proved particularly problematic as different departments within the same location operated under conflicting objectives and strategies. Sales associates received training and incentives focused on their specific departments without regard for customer experience or cross-selling opportunities. Merchandising decisions reflected individual unit priorities rather than coordinated store-wide strategies that would optimize traffic flow and shopping patterns. The internal competition extended to support functions including information technology, human resources, and marketing services. Each business unit negotiated separately for these services, often duplicating efforts and preventing economies of scale that would reduce overall costs. The fragmented approach eliminated corporate-wide standards and best practices that had previously ensured consistent customer experience across all locations. The operational consequences. The internal competition system generated immediate conflicts between business units that had previously cooperated to optimize overall store performance and customer satisfaction. The appliance division competed with the tool department for prime floor space, promotional timing, and customer attention, often scheduling conflicting sales events that confused consumers and diluted marketing effectiveness. Customer service deteriorated as employees focused primarily on their individual department performance rather than overall shopping experience. Sales associates received limited training on other product categories and possessed minimal incentive to direct customers to other departments that might better serve their needs. This compartmentalized approach eliminated the comprehensive product knowledge and cross-selling capabilities that had historically differentiated Sears from discount competitors. Inventory management became increasingly problematic as individual units optimized their own stock levels without considering store-wide efficiency or customer shopping patterns. The tool department might maintain extensive inventory during seasonal periods when outdoor equipment experienced higher demand, while the garden center faced stock shortages. These misalignments created customer frustration and missed sales opportunities. The purchasing fragmentation resulted in higher costs as units lost negotiating power with suppliers and created administrative complexity that required additional personnel and systems. Vendors faced multiple contact points within the same company, often receiving conflicting specifications and requirements from different units. This complexity damaged supplier relationships and reduced their willingness to offer favorable terms or exclusive products. Marketing effectiveness declined as individual units developed separate advertising campaigns and promotional strategies without coordination. Customers received multiple promotional communications for the same store, often featuring conflicting messages or overlapping sale events. The fragmented marketing approach eliminated consistent brand messaging and reduced the impact of advertising investments. The cultural transformation Sears' organizational culture had historically emphasized cooperation, customer service, and institutional knowledge that supported the company's integrated retail model. Long-term employees possessed comprehensive understanding of multiple product categories and maintained relationships with customers that spanned decades. This institutional culture had provided competitive advantages through superior customer service and product expertise. The internal competition system fundamentally altered these cultural characteristics by creating adversarial relationships between formerly cooperative departments and managers. Collaboration became viewed as potentially disadvantageous if it enhanced competing units' performance, leading to information hoarding and reduced knowledge sharing. Experienced employees who had traditionally mentored colleagues across departments now focused exclusively on their individual unit performance. Employee morale declined as the competitive system created uncertainty about job security and advancement opportunities. Managers who had previously collaborated on company-wide initiatives now competed directly against former colleagues for resources and recognition. This adversarial environment contributed to increased turnover among experienced personnel who possessed valuable institutional knowledge and customer relationships. The cultural transformation extended to customer interactions, as sales associates adopted more transactional approaches focused on individual department metrics rather than comprehensive customer service. The tradition of knowledgeable sales staff who could assist customers across multiple product categories was replaced by specialized personnel with limited expertise outside their specific areas. Training programs shifted from comprehensive product knowledge and customer service skills to narrow department-specific metrics and competition strategies. New employees received minimal exposure to the broader company culture and historical practices that had defined Sears' customer service reputation. This training approach contributed to the erosion of institutional knowledge and customer service standards. The financial deterioration Sears Holdings' financial performance declined consistently following implementation of the internal competition system, with comparable store sales decreasing annually, while competitors maintained growth or stability. The company's market share eroded as customers migrated to retailers offering more consistent service, competitive pricing, and integrated shopping experiences. Revenue per square foot decreased as the internal competition system reduced operational efficiency and customer satisfaction. Store productivity declined despite cost reduction efforts, as the organizational conflicts and operational inefficiencies offset savings from staff reductions and other cost-cutting measures. The company's inability to generate profitable growth attracted increased scrutiny from financial analysts and investors. The real estate strategy became increasingly important as retail operations failed to generate adequate returns. Lampert pursued aggressive sale-leaseback transactions and property dispositions to generate cash flow, while reducing the company's retail footprint. These transactions provided short-term financial relief, but reduced long-term operational flexibility and eliminated valuable retail locations. Inventory turnover rates decreased as the fragmented purchasing and merchandising approach resulted in stock imbalances and reduced coordination between departments. Higher inventory carrying costs and increased markdowns further pressured profit margins, while creating cash flow challenges that affected vendor relationships and operational capabilities. The company's credit metrics deteriorated as operational performance declined, and financial obligations remained substantial. Credit rating agencies downgraded Sears Holdings debt securities, increasing borrowing costs and limiting access to capital markets for financing operational improvements or strategic investments. The competitive response. While Sears Holdings struggled with internal organizational conflicts, competitors implemented integrated strategies that enhanced customer experience and operational efficiency. Walmart continued expanding its product categories and store formats while maintaining focus on low prices and efficient operations. Target successfully positioned itself as a design-oriented discount retailer that attracted middle-income consumers seeking quality and style at accessible prices. Home Depot and Lowe's captured increasing market share in tools, appliances, and home improvement categories that had traditionally been Sears strongholds. These specialty retailers offered competitive pricing, extensive product selection, and knowledgeable staff focused on specific customer needs. Their category expertise and integrated shopping experience proved superior to Sears' fragmented departmental approach. Amazon's rapid growth in online retail created additional competitive pressure across multiple product categories where Sears had previously held advantages. The e-commerce giant's customer reviews, competitive pricing, and convenient delivery options appealed to consumers who had historically relied on Sears for appliances, tools, and other durable goods. Amazon's integrated platform provided comprehensive product information and purchasing convenience that Sears' fragmented online presence could not match. Best Buy and other electronics retailers captured consumer electronics sales, while specialty apparel chains attracted customers seeking clothing and fashion accessories. These competitors focused on specific customer needs and product categories, providing expertise and selection that exceeded Sears' capabilities across their fragmented departmental structure. The competitive landscape evolution demonstrated the advantages of integrated retail strategies over the internal competition approach implemented by Sears Holdings. Successful competitors maintained coordinated merchandising, marketing, and customer service strategies that provided consistent brand experiences and optimized overall performance rather than individual departmental results. The strategic reversal attempts. As financial performance continued deteriorating, Lampert attempted various modifications to the internal competition system while maintaining the basic organizational philosophy. These adjustments included revised incentive structures, modified unit boundaries, and enhanced coordination mechanisms designed to address the most problematic aspects of internal competition. The company experimented with cross-departmental incentives that rewarded collaboration and customer service metrics, rather than purely departmental performance. However, these modifications proved insufficient to overcome the fundamental organizational conflicts created by the competitive structure, and many managers continued prioritizing their individual unit performance over broader company objectives. Sears Holdings invested in technology systems designed to improve coordination between business units and provide better customer information across departments. These technological solutions addressed some operational inefficiencies, but could not resolve the cultural and incentive misalignments that drove counterproductive competitive behaviors. The company also attempted to restore some centralized functions while maintaining the decentralized competitive structure. Purchasing, marketing, and customer service functions received increased corporate oversight and coordination requirements. However, these partial reversals created additional complexity and confusion rather than resolving the fundamental organizational problems. Store format experimentation included smaller footprint locations, converted spaces within existing stores, and partnerships with other retailers to optimize real estate utilization. These initiatives generated limited success as the underlying organizational problems continued affecting customer experience and operational efficiency, regardless of physical store configuration. The accelerating decline. By 2010, Sears Holdings' financial condition had deteriorated significantly, with declining revenues, compressed margins, and increasing debt service obligations that limited strategic options. The company's market capitalization fell below the value of its real estate assets, indicating investor skepticism about the retail operation's viability and future prospects. Store closures accelerated as underperforming locations became financially unsustainable, while remaining stores generated insufficient cash flow to support corporate overhead and debt service. The company's retail footprint shrank from over 3,500 locations at the merger to fewer than 2,000 stores by 2012, eliminating thousands of jobs and reducing market presence in many geographic areas. Supplier relationships deteriorated as payment delays and reduced purchase volumes affected vendor willingness to provide favorable terms or exclusive products. Key suppliers began limiting their business with Sears Holdings while expanding relationships with more stable retail partners, further reducing the company's competitive advantages in merchandising and pricing. Employee turnover increased as job security concerns and reduced advancement opportunities drove experienced personnel to competitors. The loss of institutional knowledge and customer relationships further degraded service quality and operational efficiency, creating a downward spiral that accelerated customer defection to alternative retailers. The company's brand equity eroded as customer satisfaction declined and market presence diminished. Sears and Kmart lost their positions as top-of-mind retailers for major product categories, while competitors captured increasing market share through superior customer experience and operational execution. The final structural collapse. Sears Holdings filed for Chapter 11 bankruptcy protection in October 2018, acknowledging that the company could no longer service its financial obligations while maintaining viable retail operations. The bankruptcy filing represented the culmination of over a decade of declining performance that had transformed America's largest retailer into a case study of organizational dysfunction and strategic failure. The bankruptcy proceedings revealed the extent of operational deterioration, with fewer than 700 stores remaining from the original 3,500 location network. Many remaining locations operated with minimal inventory, reduced staff, and deferred maintenance that created poor shopping environments unlikely to attract customers or generate profitable sales. The liquidation process eliminated most remaining retail operations while preserving some valuable real estate assets and brand names. ESL Investments, Lampert's hedge fund, acquired selected assets through the bankruptcy process but maintained only a small fraction of the original retail footprint. The vast majority of stores closed permanently, displacing thousands of employees and eliminating retail options in many communities. The human impact extended far beyond corporate financial losses, affecting over 100,000 employees who lost their jobs as the company contracted. Many of these workers had spent entire careers with Sears, possessing specialized knowledge and skills that proved difficult to transfer to other industries or employers. The economic disruption affected numerous communities where Sears had been a major employer and tax contributor. Supplier losses mounted into billions of dollars as vendors faced uncollectible receivables and inventory write-offs. The ripple effects impacted manufacturers, distributors, and service providers across multiple industries that had depended on Sears for substantial portions of their business volume. The analytical framework management theorists and business school academics extensively analyzed Sears Holdings' organizational experiment as a case study in strategic failure and management philosophy implementation. The analysis revealed fundamental flaws in applying market-based competition principles within organizational structures designed for cooperation and integration. The internal competition model violated basic principles of organizational behavior and systems thinking by creating incentive misalignments that encouraged suboptimal behaviors. Individual unit optimization produced negative externalities that damaged overall company performance, demonstrating why successful organizations require coordination mechanisms that align individual and collective objectives. The case illustrated the importance of organizational culture in supporting strategic implementation, as the adversarial competitive system contradicted Sears' historical culture of cooperation and customer service. Cultural transformation efforts proved insufficient to overcome the structural incentive problems created by the internal competition framework. The experience demonstrated how financial engineering and cost reduction strategies cannot substitute for fundamental retail competencies, including merchandising, customer service, and operational excellence. Lampert's hedge fund background provided expertise in asset optimization, but proved inadequate for managing complex retail operations requiring specialized knowledge and customer focus. The Sears case became a standard example in business education of how organizational design affects performance outcomes and strategic success. The internal competition experiment provided empirical evidence supporting theoretical frameworks that emphasize the importance of alignment between organizational structure, incentive systems, and strategic objectives. The broader implications: Sears Holdings' failure represented more than individual corporate decline, reflecting broader challenges facing traditional retailers during the digital transformation period. However, the company's internal organizational problems prevented effective responses to external competitive pressures that other retailers successfully navigated through strategic adaptation and operational improvement. The case highlighted the risks of implementing management theories without adequate consideration of industry context, organizational culture, and strategic requirements. The internal competition model might function effectively in certain business environments, but proved destructive when applied to integrated retail operations requiring coordination and customer focus. The experience influenced subsequent discussions about corporate governance, management philosophy, and organizational design in retail and other industries. Many companies referenced the Sears case when evaluating organizational changes and strategic initiatives to avoid similar structural problems that could undermine performance. The demise of Sears eliminated a major American retail institution that had served customers for over a century while contributing to community development and economic growth. The company's catalog business had connected rural America with manufactured goods, while retail stores had anchored suburban development and provided employment for millions of workers over multiple generations. Contemporary retail industry analysis often references Sears' decline as an example of how internal organizational dysfunction can accelerate competitive disadvantages and prevent successful adaptation to changing market conditions. The case provides frameworks for evaluating strategic alternatives and organizational designs that support rather than undermine competitive positioning and customer service. The internal decision to implement competitive organizational structures ultimately proved more destructive to Sears than external competitive pressures, technological disruption, or changing consumer preferences that affected the entire retail industry. This outcome demonstrates how management philosophy and organizational design can determine whether companies successfully adapt to challenging business environments or accelerate their own decline through structural dysfunction and cultural misalignment.